Now, the other thing we want to think about in the course of that estate administration is where we have assets which are being disposed of, who's going to be liable for the capital gains tax on those disposals at each stage in the estate administration process. Because there are some both pitfalls but also planning opportunities here to think about whether we would prefer that income or those gains to be taxable for the estate itself, which is assessed as a separate taxpayer, or whether we prefer those amounts to be taxable for our individual beneficiaries. And this is really where we need to have an understanding of the tax circumstances of our individual beneficiaries. So if we think about the fact that each taxpayer has a tax-free threshold of just under $20,000, and within the first 3 years of the estate administration, our estate gets the benefit of that threshold, but after the 3 years, we no longer qualify for it. The question is going to be whether we prefer to have income or capital gains assessed within the estate and the estate using that threshold, or if we have multiple beneficiaries, are those beneficiaries on higher or lower tax brackets? And are there circumstances where we want some of that gain to be assessed for our beneficiaries who are on lower tax brackets, where we might be able to split that income or that gain across multiple tax returns rather than a single estate tax return? And so to look at that, we start with tax ruling IT 2622, which has been around for 20 or 30 years now. And that talks about the fact that through an estate administration, the estate goes through 3 stages. And the party who's liable for tax on the estate income varies depending on which stage of the administration that we're in. And so we have the initial stage of the administration, which is when we're at the very early stage and the executor is still collecting the assets and paying the liabilities. And in those early stages of the administration, it's our estate or our legal personal representative who's liable for any capital gains tax or income tax. We then have the intermediate stage, which is usually where all of the assets have been collected and the executor is in the process of finalising things like tax returns and the payment of liabilities. And so they're approaching the end of the administration. And at that stage, the executor will have a choice as to whether they include the estate income as part of the estate liabilities and pay that tax themselves, or whether they resolve to make whichever beneficiary is entitled to that particular asset entitled to the income from that asset as well, in which case that beneficiary will pay the tax on that income. And then we have the final stage where all of the assets have been collected, all of the liabilities, or substantially all of the liabilities have been paid, and we're simply awaiting the final distribution of the asset from the estate to that beneficiary, in which case that beneficiary will be liable for the capital gains tax on that asset when it gets sold, or from the income which is derived on that asset. And so just to illustrate how that works in a practical sense, I'll probably put some words around the picture. In that initial stage there, the income ordinarily is being used to reduce debt and pay expenses, and therefore the income gets assessed to the estate as an individual taxpayer with that tax-free threshold for the first 3 years. We then get to that intermediate stage where all of those debts and expenses have been paid, and we have surplus income which is available, and the executor can then determine whether or not it will make the beneficiaries presently entitled to that income so that they pay the income tax on it, or whether the income remains within the estate and the executor pays the tax. And then finally, with that final stage where all of the debts and the expenses have been paid in full, all of the assets are available for distribution, and therefore it is the beneficiaries who pay the tax on that income, including any capital gains tax. So why is that relevant when it comes to tax planning? Well, sort of touched on this on the way through, because our estate gets the tax-free threshold for the first 3 years, well, that might be beneficial if we're talking about relatively low rates of tax, but the estate will pay those marginal tax rates on the income above that. So it'll go up to the 15 and the 30 and ultimately that 45% corporate tax rate. So if we imagine a scenario where the estate has, let's say, $100,000 of taxable income in the first year, it will still be paying tax on that, on the amounts above that tax-free threshold. If you think about a scenario where the estate has 3 adult beneficiaries, and let's say that they're young adults, they're studying, they have minimal other income, and we have the ability to split that $100,000 of estate income between our 3 beneficiaries, suddenly instead of having one taxpayer paying tax on $100,000 at marginal rates, we have 3 taxpayers paying tax on $33,000 each, and we might end up with a significantly better tax outcome as a result of being able to utilise multiple lower marginal tax rates along the way. So that's part of the analysis that we should be thinking about, particularly as those numbers get bigger. If we're looking at triggering capital gains tax, for instance, then there may be a benefit in choosing to have some of those gains taxed to the beneficiaries. And we want to be asking questions of those beneficiaries about their circumstances to look at things like whether or not they might have access to losses, which might be useful to utilise through this.